Hi, this is Daniel, and you're watching Unrivaled Investing. Beware, this is a no hype zone. We are focused on business fundamentals. We want to understand what actually makes a business tick so that way we can think what's actually driving the share price over time. We're not focused on the hype, we're not focused on the day to day changes in noise or the valuation. We want to see like what's going to drive this company long term. And today, we are focused on Switchback Energy Acquisition Corp. Ticker is SBE. They are merging with ChargePoint. What is ChargePoint? What's their business model? What do their financials look like? Let's go into detail on all these things. Do they have an unrivaled value proposition? That is the key in which I look at all investments. If you're unrivaled, you have the right to win. If you're rivaled, someone's going to steal your lunch, and I don't know how you're going to fare over time. Do you have a 10x opportunity? I am looking for big game, baby. In order to get great returns, stocks that you can hold for years or even decades, it needs to be tapping into a much bigger opportunity. Bigger opportunity meets unrivaled value proposition, meets great returns. And that's what I'm focused on. But if you don't have one of those key components, you're not necessarily going to get great returns. So that's what I'm focused on. And the last key component is I have a free investment calculator for my loyal YouTube subscribers. So that way you watch until the end. At the end, I have this free investment calculator for you to be thinking about how can Switchback do in the years ahead? How can ChargePoint do in the years ahead based on the stock price assumptions? We'll get into that. But before digging in, if you enjoy learning about potential multi-baggers, the types of companies that can go up hundreds or even thousands of percent over time, make sure you're a subscriber. If you're already a subscriber, hit that thumbs up button. And if you want to know what are the potential multi-baggers that I'm buying, what am I doing month to month, go to unrivaledinvesting.com where you can see what I buy, what I sell, what I hold. I'm not going to let go of these shares and the reason why for my top holdings. Also, the reality is all it takes is one multi-bagger to potentially change your life journey. So if you're interested, you can follow my journey as I'm trying to find these multi-baggers. That's the reason why I created Unrivaled Investing. I'm focused on these unrivaled companies, trying to find them. And this is my journey to find them. Also, I love it when YouTube subscribers post like, hey, Daniel, love this breakdown, learned a lot. Can you take this same analysis and apply it to this company? That's the reason why I'm looking at ChargePoint. I'm glad my loyal YouTube subscribers, asked me about it. And I'm pumped actually to dive into this. So leave a comment below on the next company that I should be checking out. So Switchback, ticker SBE, merging with ChargePoint. Switchback is a SPAC. A SPAC is a pile of cash looking for a deal to merge with. In this case, it's a 317 million pile of cash. In order to get the deal done with ChargePoint, where they're buying a slug of the company, they're partnering with a couple of friends, Switchback Acquisition Corp. The management goes, hey, we know some buddies. We can raise another $200 million, all in, easily 500 million plus, where they're like, we're going to buy a chunk of this company. This 200 million is through a private investment placement into the equity. And quick, I've done several videos on SPACs. I did one on Hyliion, for example, one on Hyliion IPOB. The next video is going to be on IPOC. So I've done plenty of videos on SPACs. You can check them out if you want. With Hyliion, I actually gave a breakdown of a broader detail of my thoughts on SPACs. So check that out if you're interested. The ticker at the time was SHLL. If you want to learn what I think of SPACs, but 10 seconds or less. The pros and cons of SPACs are the pros. It makes it easier and faster for those private companies to go public, and the cons is that it's easier for crap to come public as well. So shareholders have to be extra careful to make sure you're not buying into the crap. So what is Switchback merging with? Is it awesome or is it crap? And they're merging with ChargePoint, which strikes me as pretty darn interesting. They are the leader in enabling electric vehicle charging. So, when I look at ChargePoint, it passes the initial smell test of like, this is not garbage. This smells like this is steak and it has sizzle. This is interesting. So what does ChargePoint do? Because, we need to actually understand the fundamentals before we can write off like, hey, this is garbage or this is actually compelling. So they're selling the hardware and the software for landowners to build electric vehicle charging stations. The owner or the owner of the charge station can decide, if they want to have it for free or if they want to charge a lot of money. Like, hey, here's the kilowatt hour, and we're going to charge 500% premium on what it costs us to transfer that electricity. Honestly, this strikes me as a super clever business model because it's lower on the capital intensity scale, and that is a inhibitor of growth when you need lots and lots of capital to grow. Because here it is, they're just selling the tools that enable other folks to roll out those charging stations. So, for example, if you're an office complex and you're like, you know what, we want to attract the best employees over time. We know electric vehicles are becoming popular, and sustainable energy is way better than unsustainable, folks. Simple. Like, hey, we're gonna need that. So let's roll out a bunch of parking spots that have this. So they become can ChargePoint become the go-to where they're selling the hardware and there's a 100% attach rate with the software to the hardware to make sure the hardware is working right, make sure the folks that are getting their cars charged, like, hey, your car is getting charged, here's when it's going to be ready, here's the rate, here's how much it could potentially cost. And you can see that not only do they have the standalone set where it's, hey, this is the ChargePoint logo all over it, but you can also white label it where you can have the 7-Eleven logo or whatever. If you're a commercial property, you like you have the 7-Eleven, you're like, yeah, I want to attract the EV owners to come to my parking lot versus the Quickie Mart across the street, and I'm putting that here. So it's up to you whether or not you want it as an amenity or as a source of income. So I like this. I put the pick and shovel because when you have a gold rush, most of the miners didn't get wealthy in a gold rush. The ones who got wealthy were the ones that sold the tools to the miners, and that's sort of what I think of ChargePoint. They're selling the tools to a broader industry trend that should be, or at least quick gut reaction. I'm thinking this should be growing very quickly over time. So how do they make money? So first is the upfront sales, where it's the hardware, where it's based on the number of vehicles, the percentage of electric vehicles, how many charging stations do you need, what's their market share of charging stations, how much does it cost per charging station. So that's their first, selling the hardware. The second is the annual subscription. You're going to have 100% subscription each year to make sure the charging station is working. That margin on that subscription, whenever I think that, I'm like, ooh, your margins are going to be great on that. But I would expect in order to get your foot through the door, you're going to probably have low margins on the hardware. So that's the dynamic that you're going to have here. Management's presentation in ChargePoint confirms that that's the case. Margins on hardware much lower, margins on software much higher. So I'm getting excited thinking about the setup, tapping into a big market. So the business model seems pretty straightforward, but is that it? Is there more? And the reality is there's actually even more because you can layer in additional higher margin services like warranties. Like, hey, yeah, I know you just laid out a few $1,000s for your charge point station. You want to make sure it doesn't break on you, year one down, year two. And so you can get a warranty, or you can effectively get warranty as a service. And then also fleet owners, that more and more fleets are going to be going into the electric space. Maybe they want software that makes it easier for them to track which stations we should be going to, how to optimize their energy costs. So this, like, I'm seeing a lot of different ways for them to win over time, a lot of different potential revenue sources. But what about traction? Like, it's nice to have all this sizzle. Like, is there proof? Is there traction to this concept that they've talked about so far? And the answer is not just traction, leadership. They're the number one brand in North America with over 100,000 charging stations. They're operating in 16 European markets. They're 7 times their nearest competitor. They have 70% of the market share. This is super interesting to me. And you can see who their different competitors are. 73% market share versus 10% SemiConnect. Now here, if you're an electric car owner, you go, hey, I want to go look up where can I charge my car? And you pull up their app. In here, you can see, hundreds, thousands in this market. But what got me really interested when I saw this was that not only do they have their stations, but they're including other competitor charging stations in their app. Why is that important? The reason why that's important, and it's an important signal to you as a potential shareholder for a couple of reasons. One, it means management is focused on value proposition. They're focused on what's the value proposition to our users? What's the value proposition to the whole ecosystem that they're bringing? This, I like to see this because it reinforces the idea that this company is not a bunch of mercenaries. They're missionaries. They're trying to solve a problem of sustainable versus unsustainable energy. And how do we roll this out in a way that fits in a capitalistic system? So like that gets me excited. They're focused on the value proposition, even if it means showing a competitor's charging station. And also doing that suggests to me that the competition is actually less cutthroat than I'd expect. Maybe, just maybe, when you see this level of maybe friendliness, even where you're showing like, oh yeah, there's these other charging stations, it might suggest that if the economics aren't attractive, or let's say these great forecasts that these companies are putting out don't pan out, maybe you see some mergers and acquisitions in the years ahead, where maybe like ChargePoint gobbles up, SemiConnect or Blink, or these folks merge because it's not profitable, but they are all working together in the first place by working with ChargePoint to make sure they're on the ChargePoint app. So it's an interesting data point. Okay, but does it work? From the customer perspective, and it seems to work because they're working with all the major players, and like you can see what car companies they're working with. Like these are all the major brands. They're working with key tech partners. They're working with major fleet partners like Waymo, Lyft, and Uber. So I'm seeing this as like this is not just a solution trying to address where we are today. This is a solution trying to address where are we in 5-10 years from now, where more and more companies are developing EVs that have mass appeal. It's not just Tesla. Maybe Ford has something, maybe BMW has something, GM. They're working with them now. So that way their stations are fully functioning when these auto manufacturers are rolling out those EVs in the future. This is solving the chicken or the egg problem of like, hey, like can we start even selling these if there's not enough charging stations? Oh, we're solving that problem by working with ChargePoint now. So this is exciting to me. Like I see this as like, oh, they're solving this problem. They are definitely trying to make this work. Let's see it from the consumer perspective. What's the consumer think of ChargePoint? If you check the app, overall very favorable ratings, 4.6 stars. People love the app, but when you read the reviews, you do get the sense that look, this industry is very early on. It's a little bit of the Wild West. Some people, have negative association with ChargePoint because they'll go to a charging station and they're just getting their face ripped off because the markup is 500, 600%, and they might have the perspective of like, I was hoping that I could get this free, or I knew it was going to cost me, but I didn't realize it would cost me this much. So you get the favorable reviews, but overall it's early on, very early days for the ecosystem. There's the Wild West aspect. Some of the reviews are like 1 star, can't believe it cost me this much. Other people don't like aspects like ChargePoint had a history of effectively billing your credit card or your account to fill it up before your next charge, and they're like, hey, I didn't authorize a $10 or $50 charge for my next charging. And so there's some, you can see some negative reviews about that. I don't know if that's tied to prior leadership at ChargePoint, but anywho, these are the points that you would see with a fast growing sort of early stage industry. But by and large, seeing that they're the number one player with an app that works with the whole ecosystem, so the consumer wins. But there are some things that need improvement, need filtering. Like here's this request from February 2020, like, hey, can we have a filter where we sort by price, help spur competitive electricity's pricing to further accelerate the transition, i.e., like, hey, I don't want to get my face ripped off. Like, I know that this one's going to charge, but which one's like, and that would be easy rollout. Be like, this is going to charge X% above their cost of kilowatt hour, and this could be like crazy amount. So that's I can understand. This is early days, wild west of electric vehicles. But overall, very favorable. So what is ChargePoint's potential? And management's pointing to huge, enormous. The energy, electric vehicle infrastructure market's gonna be $200 billion. And so ChargePoint's like, yeah, we're only doing 140 million in revenue. It's down a little bit in 2020 because of COVID, but we were growing real well in prior years, and we're gonna do $2 billion by 2026 because we have this great market share. We have these great partners. You see all these auto and fleet partners. This is a classic hockey stick graph where it's like, boop, 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 and so whenever I see these things, I'm first of all like, yeah, I don't trust them. And that's the first like gut instinct. Second is like, why are you going to get this hockey stick aspect? Like, I want to understand this in greater detail, and maybe I can like get in. No one says you have to buy like uh here and be like, oh man, I missed this. You can buy here when they start proving it out, and you'll get your return from here to here as the fundamentals continue to grow. So like, no one says you have to get it. You have to wait till it all panned out, like I missed it. Like, my view with investing is you can always, if you're not crazy about it now, wait for some execution, wait for them to be here, and then get in. Anywho, that's just my own take. But let's get it. Let's dive into why they think they can grow this much. And so they're saying, look, the number of ports, the charging stations that they have, it went from 17,000 to 24,000 to 32,000, down a little bit this year. But then presumably as COVID, there's a cure for COVID. Then things ramp up 50,000, 80,000, 140,000. We're going to be selling 500,000 units a year by 2026. And you can see like what's driving their revenue. And this gets to the point earlier. They're going to have hardware, and the hardware is the majority of their sales. But as they grow, because that software, you're charging the same software each year, that gets to a bigger piece of the pie. But by and large, like that one-time sale, the networked charging stations, that's still going to be the vast majority of their revenue by 2026. So that means margins will continue to stay low for some time. But still, I feel like when I'm looking at this, like, okay, 32,000 to 425,000, over 10x growth in just the next few years. Why? Like, I need to think about this. Like, I get it. I get the excitement. Like, man, I wish someday everyone's driving a sustainable, vehicle. I get it. I get the appeal, but I have some questions. And so my questions are, first, why the step change in the number of ports shipped? Because I'm looking at 2019, I'm looking at 2018, and I'm looking at 30% growth each of those years. And those were actual growth. So from 2018 to 2019, it was 32% growth in the number of ports shipped. Then I look at 2018 and it was 38%. So it's a step down. This is pre-COVID. So then you look at 2020 and you're seeing a decline. Okay, so ignore 2020, ignore 2021, because presumably you have, sort of this COVID reversal, things start working out. But then 2022, 2023, you're at 58% and 75. Why the step change? Like, what's the why are people just why are either residences, help me understand that growth rate change, because that's a big deal in terms of forecasting. Like, if you were to say, yeah, I think this is going to do 30% a year, I'm like, okay, like I've seen it, but what's driving the acceleration from here? Like, normally you don't see that. You see, as the company gets bigger, it's harder for them to keep up their growth rate, not this, dramatic acceleration. Also, and this is a key question that I don't think management, I've read through the transcript, I've gone through their presentation a couple of times. This is a key point that really wasn't touched on. And it bothers me quite a bit, because this is the key to this whole chart here, which is, what's the reason that they're doing it? What's the reason that the landowner's doing it? Like, if it's free and it's to increase the amenities, you're a nice apartment complex and you need to attract, the people that are going to pay a premium for your rent. And so you're going to put a ChargePoint electric vehicle, charging station there. I can understand that. But that creates a free aspect, or maybe it's a minimum markup, like paying quarters in a laundry machine, like what was previously done. And so what is the ROI that causes people to install this? Because if it's just amenities, why is it going to accelerate from 30 to 75%? Like, I'm thinking, like, if you're just offering something for free, most corporations aren't just that generous. Like, oh yeah, we're gonna spend $1,000, $3,000, $5,000 on a new charging station for one charging station, for free, just for people to be nice. Like, I get certain aspect. Like, hey, we're the 7-Eleven. We want to compete with the Quickie Mart, so therefore we're gonna lay out a few $1,000s, and it makes the attraction of driving to 7-Eleven that much better. But I'm just trying to understand what's the return on investment for the installation of a unit, because I didn't see that really in the presentation. I don't hear management calling it out. And the challenge is that it's a very rivaled offering. Some people are going to be expecting it for free. Others, in some cases, people just want a moderate charge. So it makes it challenging for me to believe that this is just going to get rolled out super fast when I don't know that the end buyer is getting a great return on investment. And that is the key to unlocking this growth. Like, if it's beyond just an amenity that you're saying, hey, we're going to improve our offer. Like, hey, this grocery chain, now we have electric spots to say thank you to all of our loyal shoppers. Like, I get that. But in like it doesn't seem like that we're at that point yet. Now maybe we'll reach that point. Society will reach that point, in the coming years, where it becomes table stakes to have electric vehicle charging stations, in every grocery store parking lot. But I'm just not seeing it there where you have to have it. And so it's tricky to like underwrite. Yeah, I think this growth is going to accelerate from here. Why is this an important point to consider? And here's their forecast, and these figures are what's driving their forecast. And they're saying, like, look, our revenue is going to be up 46% next year, 75%, 74%, 63%. And so they're going from 100 million plus to nearly $1 billion over the next few years. And they're saying the amount of money we're raising now, this is going to cover us until we're profitable. And you see that we're EBITDA positive. EBITDA is a proxy for cash flow. It's a very rough proxy. Sometime I'll make an EBITDA video exclusive for Unrivaled Investing Journey subscribers to view. But this is, they're saying, look, the money on our balance sheet, we're going to be set. Now, if you take this same growth rate of 135 million and you're like, yeah, but I actually think it's going to be 30% growth over these next 4 years, then you're going to end up at sub $400 million. I'm sorry, I'm just pulling out my old TI-82 calculator to quickly check out, what it would look like. And or excuse me, TI-83 plus. And in that case, your revenue is sub 400 million versus their nearly $1 billion. In which case, here's their operating expenses of 300 million. They're going to be at a pretty sizable loss at that point. I'm thinking there's going to be no way that they're at the point of fully funding this business model. In which case, if your growth rate, doesn't have this dramatic acceleration, hey, and if it does, that's great. But if it doesn't, like, I don't understand what's the ROI that drives it. What's the return on investment for landowners to be like, yes, I'm going to get 10% return on investment by doing this. So for sure, I'm going to roll this out. Until I see that, if this is only 30% a year, then there's a good chance that you're not, making the money you need to have. And then you ultimately burn through the cash you have. And the reason why that's important is they're saying they can fully fund. And if they don't fully fund, they're going to need to raise more money. And if they raise more money, not now they're flush, but I'm saying in a few years from now, they're going to need to raise more money potentially, and that means dilution. And when you're selling more stock, that means you as a shareholder, you own a smaller and smaller and smaller share of the pie. So that's why I would want to be super clear. Like, yes, I can be confident about this growth, this acceleration of growth in the future, because the ROI is so good for landowners, for station owners. So I'd want to understand that, or at least I'd want to see like the growth of the amenities of like why they're definitely going to do that going forward. I just like to have a little bit more proof. And once again, as I was saying, I don't need to get in, right here in the business model. I'm okay waiting until here and going, oh, okay, they've proven themselves. Like, a lot of people could say, like, look, Daniel, they've already proven themselves with with this level of growth. Like they've already proven themselves here. But for me, I don't mind waiting, especially when you're saying that there's going to be a step change in growth. I would rather just, wait until here before I consider. Um, what do I also here's a key point looking at this. They're saying like, look, our gross margins are going to expand quite a bit from 24% to 40%. This actually makes sense because slowly but surely that software subscription part of their business is going to be a larger and larger portion, resulting in larger and larger gross margins, and that should flow through to better EBITDA margins. So that's important for you to think about as we consider like what's the risk reward here that we want to think about. So what do I think about the risk reward? How do I think about the valuation? And so here are my thoughts on the valuation. And keep in mind, this is my value proposition to you. I'm going to drop this free valuation sheet here in YouTube. You click on the description of this video. There's a link. You can click on it. You download it. You can play around with the assumptions. And so if you disagree with any of my assumptions, change it. That's why I'm doing it. This is a hypothetical valuation framework in order to think about, these potential investments. So here it is. It's around $14 a share. Today that I'm making this video, it's down 7% today. So it's trading at a nice 40% premium above the $10, initial deal price. So that's nice. So people are like, hey, I love this deal. That's what the market's saying. So $4 billion valuation on 150 million in revenue. They're expected to decline. The revenue is supposed to decline this year of around 10%. So I'm putting a range of -15 to -5. What's the question is, what's their operating margins long term? And just by 2026, and keep in mind this is the optimistic model where they're hitting $2 billion in revenue. They're saying they're getting to 16% EBITDA margins. So when I see that, I'm thinking optimized margins, maybe 10 to 15, 20%. Maybe higher. You want to say, well, Daniel, you're not thinking far enough forward. You need to think 2 decades down the line where software is 80% of their revenue because they already have a global fleet of charging stations, and now they're just this toll collector, collecting their annual software revenue, and margins are much higher. So I could understand that argument. I think it would be decades from now. But if I'm an investor with, like, let's say a 5-year time frame, I think that's long term enough, at least to size up an investment in this case. So I think in the next 5 years, like, maybe we're penciling out 10 to 20% margins. Maybe you want to pencil out higher. That's up to you. And so, based on that, slap on a 25% tax rate. It implies, a 200 to 400 times earnings multiple, which is obviously, astronomically high, extremely high. That means, people are really excited about the story, and they're very confident that the company will deliver on their growth. And so then let's take this 5-year time frame where we assume a growth rate, going from this revenue, here's an annualized growth rate of 130 million. Take a 30% annualized growth rate, and that means by 2025 you're around 500 million. So that, or the upside, you go from 144, you compound it 50% a year. That would be lofty. Maybe it happens, and now you're at $1 billion in revenue. Once again, this whole range of estimates is actually well below, what they're targeting, because they're saying 1.4 billion in revenue. And part of this is just given my skepticism, like, hey, why are you going to have this step change in growth? Why are you going to have this acceleration? But if you're like, hey, I just want to drink the Kool-Aid, like, I love this story, and you want to update this to make it 60% on the low side and 80% on the high side, why not? It's your money and your assumptions. You can play around with the sheet. My value proposition to you is I'm trying to make it easier for you to think about this in a rational way. Of course, the stock price can go way higher or way lower than what I'm penciling out. That's the nature of the stock market. You get animal spirits in the long term. Animal spirits in the short term. Long term, it's driven by fundamentals. What's the value proposition? What is sales? What is earnings? What is cash flow? And so here, penciling out 50% annualized growth, assuming that 20% optimized margins that you're going to value it on. And, that gets to around 164 million in net earnings, because I'm slapping on this 25 times tax rate. Assuming this lofty 40 times, earnings multiple, keep in mind that's 5 years out that I'm slapping on a 40 times earnings multiple, and then you got 50% upside. So I'm thinking 5 years from now, there's 50% upside to this, and in the downside, there's 80% down, and maybe even more if they have to do a capital raise. So as I'm looking at this, I want to take, like, it's important to call this out. Sometimes you find companies that you really like. Sometimes you find companies that you love, and you're like, look, I love the mission that they're on. And personally, I love the missionary zeal that they're saying, like, hey, we've been looking to build out this network even before it was popular, even before Tesla was a major company. We were trying to figure out how do we build an electric network. So, like, they have videos talking about that. So I love that missionary zeal. I'm excited for them, and I want the world to transition from unsustainable to sustainable energy. So I'm all for the mission. I'm super excited for them. That said, you need to be able to separate as an investor. You need to think about, like, what do I want to support? What do I want to own? And you also need to think about, like, am I going to make a good return on my investment? If you just want to invest for, like, philanthropic causes and be like, hey, I want to support you because I like the mission, that is fine. Like, I know a lot of Tesla owners do that where they're like, I love Elon Musk, take my money. And, like, I get it. That's totally fine. Like, if that's how you want to live your life, God bless. That's awesome. Like, for me, while I'm thinking about every investment, I would rather separate philanthropy or giving away money very differently from, like, hey, how am I going to make money on this? And so I need to think about what's the risk reward when I'm looking at an investment. And in this case, I don't think the risk reward is that compelling. If you've seen my other videos, you'll see situations like, as an investor, I want situations where heads, I can make a lot, tails, I don't lose that much. That's the type of game I'm trying to play. And in my videos, most of my videos, I call out upside, downside. And when you have something where, like, 5 years down the road you don't lose that much, but you could also make a couple 100%, now you're starting to get interesting. Now it's worth sharpening that pencil, to dig a little bit more. So I'm not crazy about the risk reward here. I do like the company. However, I think they do have a strong value proposition. Like, hey, if you have 7 times more charging stations than your nearest competitor, it's easier for you to become, like, the de facto next charging station. That, let's say Disney, they're like, yeah, we want to roll that out in our parking lots. You become the de facto, you become the default purchase because, like, you're so much bigger. You have this network. So, or you're a car company and you're like, yeah, like, who should we partner with to make sure our vehicle fleet, is compatible with charging stations? Yeah, you're going to go to ChargePoint. Or you're a consumer and you're like, well, who's the most easily, how can I find the most easily available? Yeah, you're definitely going to download ChargePoint because it's 7 times more than their nearest competitor. So I love the ecosystem aspect of ChargePoint. Like, there's a lot that I like there. The financials just don't. I don't love them. Love the missionary zeal. Don't love the financials. Don't love the risk reward. That said, if you want to see what I am buying and selling, what I'm holding, go to unrivaledinvesting.com, click on Journey. I have exclusive content each week just for Journey subscribers. And remember, finding one multi-bagger can potentially change your life journey. So if you're interested, follow my journey as I'm trying to find these potential multi-baggers. And if you enjoyed this video, make sure you subscribe. And if you're already a subscriber, thank you so much for watching, and hit that like button.